So we are broadcasting, and I've got a really good turnout for you today. And Sam says hello.
Hi, Sam.
And if there's any point in this call you can't hear me, just let me know, please, because I have a habit of babbling on.
I'll do this.
So good afternoon, everybody. Thank you very much for joining us. So we are on time, which is great for Friday. Hope everyone is doing well. As usual, we're just going to wait a couple of minutes for everyone to join us this Friday afternoon. Hope everyone's got a nice cup of tea. If you haven't, I'm going to give you all a minute or two to go grab a drink, tea or a coffee, to warm up, because it's super cold out there. It's absolutely freezing. I'm not sure where everyone is, but a lot of people have been messaging me pictures of snow. It's absolutely cold, so it looks like winter is in full force now. But you've got your short sleeves on, Bob. What's going on there?
Show my muscles.
Showing your muscles.
Yeah. I only wear full sleeves with a suit. I don't know why.
Oh, that's weird.
I can wear the cufflinks. Yeah.
That's really weird. But it is absolutely cold. How are you doing? All right, Bob?
I'm all right, actually. Yeah, it's been a very busy week. As usual, I'm working, till late hours trying to catch up. We're still behind. There's so much work out there.
Stop eating all those fancy lunches, Bob. We know that's what you're doing.
Sorry?
Last time you were on the call, you were like, right, I'm going to go for my lunch now. That's what.
Yes. No. I've had my standard toasty this morning already, so I'm going to not eat now until 2 or 3 o'clock. So I'm fine.
But it's great to hear that you've been really busy, because last time we had you on the call a couple of weeks ago, you were really busy then. And, we had a really good turnout for you as well. You were talking about... what were you talking about now? I've forgotten. We were talking about mortgages, you're talking about bounce back loans, you're talking about furlough. We had a very interesting conversation as well. So loads of really good questions coming through about that.
Yeah, it was a very good session last time we were on air. We had so many inquiries from all the Midas listeners, so thank you for that. But yeah, there's a lot of business out there, a lot of activity. Now, that's obviously because of the stamp duty holiday. So when that ends, who knows? Will it be renewed? We don't know. But certainly we've got another 3 or 4 months of, fairly busy activity ahead of us.
Awesome. So, all right, it looks like we've got quite a few people on. I think we are ready to start. I'm just going to check with my team. Hold on 1 second. Sorry, I had to mute there. I had to speak to my team, because we are also going to be streaming on Facebook as well. So good afternoon, everybody. Thank you very much for joining us, and a huge thank you to Bob as well. This is your second appearance, I think, with me. Lucky you. But thanks for joining us. It's all a bit chilled out on a Friday. We're here for 1 hour. Yeah. Just a couple of notes before I actually start. Just to make sure that the event goes on time, it is a 1 hour slot. We have kind of started already. We're going to be streaming live on Facebook as well. So if you see me sort of on my phone or looking in different directions, it's not because I'm distracted, it's because we are streaming on Facebook, so I need to watch out for all the comments as well. Because we want to end this at 1 o'clock, we know Bob's got further commitments as well, and I'm not just talking about his fancy lunch. So we have actually muted everybody, so if you've got any questions, we have at the bottom of your screen you can see a Q&A tab. So please, at any time of this event, please ask any questions and we will answer them during the event, or probably towards the end of the event. If there is a question that you think, oh, you know what, I really can't bother to type this up because it's too long, raise your hand. You have a raise your hand option on your screen as well, and we will invite you to the panel. Feel free to share your screen and you can just talk to us about any question that you have. I can't stress to you about the time. We only got Bob for 1 hour, so please try and keep your questions to sort of like around 30 seconds or less, so it gives everybody a fair opportunity to ask a question as well. People are going to be dropping in and out. We completely appreciate that. So ask your questions. Yeah. So ask your questions using the tab as well. If you do need to leave, just a quick reminder, we will be recording this as well, and it will be uploaded on our YouTube channel in a couple of days. So if you have missed anything, you can feel free to give us a call at Midas, and we'll be happy to share the contact details for Bob. And you can also watch it on our YouTube channel a little later on. So my name is Aarti, and it's an honor to have everybody here today on a Friday afternoon. I'm really excited to have Bob Singh from Chess Mortgages here today as well, and he's going to be talking about financing developments as well, how to finance your projects. A quick introduction about Midas Property Group. We are a property sourcing company, so we will buy and sell properties for you anywhere. So if you are looking for properties, or if you've got a property portfolio that you would like to expand or decrease, and contact us. We certainly can help you out here. As well as that, we also run events as well, which is something that I do. So we do property events, all being streamed online at the moment because of the current pandemic. We've got a few events coming up before Christmas, so I know a lot of people are asking, is this your last event? No, it's not. We've actually got 2 next week. We've got a really big one on Wednesday morning. It's property question time, which streams live just before the auction event at 9:30. You're all invited to this as well. I will send you out the details. And we've got another event on Thursday and a couple more before the end of the year as well. So it's pretty busy here at Midas Property Group with events and in terms of buying and selling property. Right, okay, that's my brief introduction. A couple of minutes in now as well. So I am actually going to pass it over to Bob. I'm going to mute myself for the next couple of minutes or 20 minutes or so. If anyone is struggling to hear either one of us, please just raise your hand or just let us know. And thank you very much. So Bob, over to you.
Good morning, everyone. Thanks for tuning in to the Midas show. My name is Bob Singh, surprisingly, and a big thank you to Aarti for allowing me once again to come on the show. I must have done something right to be allowed back again, so I'm absolutely grateful and delighted to present to you again today. Today's topic is how to go about furthering your portfolio, and in particular, funding development projects. So if I'm allowed to share my screen.
Yep, you should be able to share your screen, so go for it.
Right, let's do that. Has that worked?
Not yet.
We'll soon be there.
There you go.
There we go. Okay, fine. So, right. This is me, Bob Singh. I am a mortgage strategist. That's just a fancy word for mortgage broker. It's only because I've been in the business for so long and gathered so much knowledge on lots of other factors that I like to call myself a strategist, because buying a property, moving home is all about having the right strategy in place. And if you don't have one, then you're not going to be very successful. So it's good to start off on the right foot. And what we offer is a long-term business relationship. In your journey, you are going to need a good lawyer, you're going to need a good property sourcer, Midas, and you're going to need a good mortgage broker, hopefully myself. Now, with those 3 people behind you, you're pretty much ready to go on your journey, and this is what it's all about. It's forming a relationship, having confidence in your advisor, in your lawyer, in your sourcer, so that you can actually go out and make bids on property with full confidence. I've been in the business for sort of 40 years. Started off in banking, became an IFA, an estate agent, developed properties myself. In my time, I've won several awards for my advice, and I've also appeared on national radio stations and also was mentioned in the Daily Mail recently. So that's a bit about me. These are my contact details, but if you have any queries or questions or any financing requests, please route them through Sam or Aarti, and they will take your details and pass them on to me, and I will come back to you hopefully same day and answer to the best of my knowledge. So they are my contact numbers, but as I said, contact Aarti if you need any specific advice. So this is what we do at Chess Mortgages, pretty much everything that a good broker would do. It's the whole suite of mortgage products, not just vanilla things. And it's much more than your high street bank is going to offer you. So if you ever experienced an application process recently, you'll know that banks are very, very busy. They don't give you advice. They're not allowed to. So when it comes to selecting routes or products, they can't say, we recommend this. They just say, here's a list of products, take what you want and what sort of fits your needs. So, but today's program is all about development funding. Hence it's highlighted in red. But you can see from that list, there's a lot more that we can do. So if your need isn't purely development, then we are here to help you on that point also. Right, just need to just go back a slide there, I think. But yeah, I mean, how do people, not used to this sort of a thing at the moment. This slideshow, right. Just go back a bit, do beg your pardon. Just go to that bit, yeah. So today's program is obviously about how to finance development projects. I guess that's what you're all tuned in for. You may be fairly new to the business, you may be an experienced person. So I've kept this presentation fairly generic, but if you have any specific questions, I'll be happy to answer them after the show. So how do people finance projects in today's world? Cash, obviously. Now, cash only happens up to sort of the £500,000 level because nobody really keeps £1 million doing nothing in the bank. We all know banks only pay 0.01% in interest, so it's hardly beneficial to leave savings in a bank. Mom and dad play a very, very big part in property purchase these days, particularly for first-time buyers. They are the person who gives you that push and gets you on the first rung. Now, if you add up all the money that parents give to their kids to buy property these days, it's probably the same size as a number 6 building society in the UK, so it's quite massive. You could borrow from the family, you could sell some assets, take a bank overdraft if your bank is willing. You could rob a bank, but I don't advise it. You end up in prison. And actually, believe it or not, I've seen projects being funded by credit cards. Not the best thing to do because credit cards are personal borrowing and they appear on your credit file. And when it comes to borrowing more money, your debt to income ratios are out of kilter and you could get declined. So not least the rate of interest you pay on these sort of things. I know a lot of people play and juggle the credit card market by going to interest-free stuff, but it's not the best idea. So the best and the most popular methods of funding property development are going into partnership with a partner as a joint venture. That could be actually with somebody who shares the same sort of vision as you do. It could actually be the seller of the asset. We see that a lot where people do joint ventures with the person selling who may not have the expertise or the finance or the time to develop that particular property. So that's often a good route. What it means is you can cut out a lot of the funding costs because the asset is already owned. Bridging finance is popular, development finance. We'll go on to discuss those two in a bit more detail. Now, people can go to their regular banks as well. Now, banks aren't currently in the best of moods. They're a bit nervous about next year. So to get development finance from a bank, unless you're a seasoned developer, it won't be that straightforward. Hence why the bridging and development market is so busy. They're taking what the banks don't want to lend on, which is 90% of it really. The other popular source of funding is actually refinancing your home. Now, because it's a residential property, you can get a further advance from your current lender or a secured loan from a third-party lender. And because it's for business purposes, that is allowed. And second charges are a bit more generous in their calculation criteria. First charges are regulated, which means the bank is duty-bound to verify your income, prove your affordability, and then lend you based on that figure. And if you ever need to borrow more than that, as I said, there is a second tier of lending available to help you on your journey to your first or second development project. So secured loans and other forms of equity releasing, that could be money from your buy-to-let portfolio. If you've got equity build-up, we could actually release some of that. So when you come out of your penalty period, that's the best time to take money out, because then you can maybe switch banks, get a better rate, borrow more money at a better rate, possibly, and use that money to fund your next project. So what is a bridging loan? A bridging loan is basically bridging the gap. Now that could be bridging the gap to a remortgage down the line, or a sale. So there's an entry point and there's an exit point. A bridging loan is basically bridging the gap between the two. Now these loans typically are no longer than 2 years. Typically 1 year. Nobody really wants to borrow bridging for too long because it does cost. And there are different types of bridging loans. You can have those where you pay the interest monthly, which means you'll get more upfront. Or if you wanted to roll up the interest for 6 months or 9 months, then what the bridging lender does in that scenario is deduct that interest from the loan and give you a net figure. Maximum lending is still 75%. Now, some valuers use different mechanisms to value property. Some may market or value it on a 90-day forced sale value. Some might do on a 90-day open market value. So it does depend on which lender you go to. But 75% is pretty much the cap at the moment. Now, bridging lenders will charge a fee for setting up the loan. It does seem excessive, but in commercial circles, you'll soon find out it's not. Those fees are typically anywhere between 1% and 2% of the loan amount. You'll pay your valuation fee on top. Bridging lenders don't normally trust anybody but their own lawyer. Yeah, they'll have their own sort of firms that look after their interests. And if you use anybody else, then you'll have 2 sets of legal fees to pay as well, because their lawyer will make sure your lawyer has done all the work they need to. Normally, there are no exit fees, but be careful. It could be in the fine print of your bridging loan offer. There should not be, because the market is quite competitive. You can negotiate terms where there are no exit fees, and that could save you a lot of money. And the good thing is, because of the competition in the sector, more than 200-300 lenders now actively in that space, rates have been driven down by competition over the last 3 or 4 years. And now it's not uncommon for a low loan-to-value loan to be anywhere around the 0.5% mark, which over the year is about 6%, which is not too drastic. It's just above commercial lending rates. So it's a price worth paying for the ease that you can actually avail the money. Bridging finance is not regulated. The FCA do not have any say in it. It's very much the lender's own decision and policies that dictate, and therefore most bridging lenders are not regulated. Now, more and more are coming on stream that do offer regulated lending, but we'll talk about that on a different program. So the sort of bridging loans you can get are on a first or second charge basis. Generally first charge, because they don't like to be behind somebody else. That means they get second bite at the cherry. And if there's not enough equity, or if the property is sold for a lot less than everybody thought it was worth, then they're not going to get their money on a second charge basis. So for that reason, second charge lending is at higher rates. So don't expect to pay the 0.5s and the 0.6s on a second charge. That will be well over 1%. So as I've said, with any sort of lending, your asset is at risk. Now, you'll find in the fine print of any bridging loan offer, any lender of that nature does have the right to appoint a LPA receiver. So if things aren't going so well, it doesn't take them long to put somebody else in charge of the asset, take control of the project or the rents from that asset, and manage it on your behalf with a view to possibly selling it at auction to get their money back. At auction, you're not going to get a fantastic price. So we might just sell it for just above what their loan amount is, and you've lost everything you put into the project. So, but having an exit strategy, planning from the outset, is absolutely key when you play with bridging loans. They are highly dangerous if misused. Yeah, unless you know what you're doing, do not take on a bridging loan because things can go wrong. Now, development finance is a little bit different. It can be stage 2 funding. So people may use a bridging loan to buy the asset because for whatever reason, and then apply for a development finance loan. You can go to development finance straight off, but this is a sort of lending that's done in stages. They'll lend you money to buy the asset, and they will then lend you the money to improve it. Typically 50% upwards they will consider, and that all depends on your experience, the loan size, the market or the area or the geography of the property itself. And the good thing is, if it's a good project, these lenders will come in and fund virtually all of the finance, give you 100% lending with a view to getting the project done for you, so that you can either sell it or refinance it. So these bridging loans, again, aren't too long in duration. They tend to be 6 to 18 months typically, can go a little bit longer, but I don't think that most developments take that long. So if you have to borrow money for so long, it must be obviously a big project, but I guess most people manage within 6 or 9 months. Rates, anywhere between 7 to 9% per year. Not bad considering the lender is taking a higher risk in you. You know, the project could go belly up and they could end up losing a lot of money. So risk is, pricing for risk is key these days. Lenders do want to make a profit. And if you've ever taken a bridging loan or a development loan and not paid it back in time, you do get faced with large penalties. That's why I'm saying read your offers carefully. A lot of people just sign on the dotted line, take the offer, and little do they know they're committing to a lot of little things. So it's always it's wise to know what you're signing up to. And that's what your solicitor is there for. Not only will they check the title and everything else, they will also go through the loan offer with you and just explain the ins and outs and make sure you're fully aware of the fine print. You're going to face fees, obviously. Again, 2% is not untypical. You're going to pay the valuation fees. You will have quantity surveyor fees, because having lent on that project for you to develop, the lender will want to keep a close eye on what you're doing, your pace, your quality of work, and they'll send out a quantity surveyor to just take pictures, assess the progress so far, and at every stage you'll get released a sum of money, because they normally pay in arrears. So you will have to do the work, show it to the quantity surveyor, and then they'll sign off a check, and then money will come into your bank so that you can pay your builders and suppliers. But always build in a contingency fund when you are budgeting ahead. And obviously we poor brokers also need to make a living, so we do make a small charge, typically from 0.5% to 1%. If the loan is worth several millions, we may just charge a very small administration fee and not charge a percentage broker fee. So again, these things are negotiable and very much down to your negotiating skills. So what is the lender looking for when they lend money to you for a development? Experience is probably the biggest thing. Now, it's taken for granted that everybody must, do their first development. So in some cases, the person applying for that finance is not going to have years and years of development experience. So in that case, what they look for then is the experience of your builder. Who have you engaged to build the project for you? If it's a reputable builder who can demonstrate competency, then providing there's a contract in place between you and the builder, then the bank will consider your first development project just as they would for an experienced person. If you have done previous projects, then it's always good to make a portfolio of your previous projects so that you can demonstrate the costings of each product that you actually did, how much you bought it for, how much you made on it, because the lender is looking at you as a person, how driven you are to complete that project successfully and turn in a profit. Anybody can do a project and make a loss, but making a profit is an art. It's done through careful planning, careful costing and cost management. So they want to see that you're frugal. They want to know how much your money you're putting in yourself. They're putting their neck on the line. Are you doing the same? Are you putting in a significant enough stake for it to be for it to hurt you if you would lose it. So that's why they ask for 25, 30, 40% even on some projects when they are lending the money to you. Planning permission, obviously, with permitted development coming in, sometimes you don't need full planning. They will want to know that if it's a ground-up development, you've got the right planning. Maybe they can suggest ways to improve it for you. They are very experienced in this field. And then also looking at the quality of the development itself. Is it in a good location? Is it a good margin? Et cetera, et cetera. So they'll be looking at those and doing a lot of local research as well of similar developments that have happened in the area. They're very keen on not taking too many big risks. So loan to values will not ever creep more than 70, 75%, unless of course there's additional security. So if you are adding in more properties, if you're adding in additional unsecured collateral into the mix, then you will get higher lending than 70, 75%. Most of these loans, particularly if you're borrowing in a company name, will require a personal guarantee from the directors. So be prepared to sign that. And sometimes you need a second independent lawyer to go through the terms of the guarantee to make sure tomorrow you can't say you didn't know what you were signing. So they make you take separate legal advice in some cases. So be ready for just a bit more extra legal fees if that happens. So they want to know who the builder is, and they want to know what market conditions are in that particular patch of the woods, because conditions vary geographically. They have their finger on the pulse pretty much. So if you're trying to build a development in an area that's dead, they could make more demands from you in terms of deposit or further requirements. Timescales, how long is it all going to take? Very, very important. You don't want to be locked into a bridging loan paying 7 or 8% for too long. And obviously from a money laundering viewpoint, they also want to know where the money is coming from. So the source of funds not only will be checked by you, the lender, your solicitor will also be very interested in where the money is coming from. So the whole process is quite streamlined. There's normally an application form that you fill in, 2 or 3 pages long, giving a bit of a history about yourself, your asset and liability position. There will be 2 valuations, typically. One on obviously when you're buying it, and then they'll do an end valuation as well once the project is pretty much finished. And most lenders do require, as I've said before, 2 solicitors, one for them, one for the other party. But the most important thing is for you to do a cash flow forecast, which basically tells the lender at what stage will you need the money, how much, what for, so they can obviously gauge what their exposure is going to be at any given time in relation to the progress being made on that particular development. They will keep a close watch on you, so do expect for somebody to be watching over your shoulder, making sure you're doing the right things. But as the bank gets more confident in you on your second or third development, that could ease off a little bit if they know that you're in good hands. So what are the fees that you're going to be coming up against in a development? We've talked about valuation fees and lender fees and everything else. The interest is obviously upfront or taken or paid monthly. 2 sets of legal fees, possibly 3 if you need separate legal advice for the guarantees. And stamp duty on residential property. Obviously, we have the holiday since till the end of March next year. But on commercial property, different rules apply. And if you go to the .gov.uk site, there is a stamp duty calculator on there which explains what you will pay on that particular property. Obviously, the market's quite busy. Commercial lending does take a little bit longer than residential. So, but be careful if you are looking to trying to complete before the deadline, that you do start early. Do not leave it to the last minute, because you could run out of time. At this point in time, we don't really know whether the Chancellor is going to be, extending it, or whether he's going to be, keeping it as it is. That remains to be seen, but it's unlikely because nobody's mentioned any hint of any extension of any stamp duty deadline. You'll have costs relating to your planning fees, your councils, your architects, so they too must be factored in. And the build costs, they're quite important because I see a lot of quotations rather than, and estimates rather than firm contracts. Your build must be a fixed price contract. It cannot run over because that'll catch you out unless you built in a massive contingency fund. So a lot of builders like to give estimates, and don't take an estimate, don't take a quotation. It has to be a fixed cost contract, and everything must be detailed to the last nail as to what they're going to do for their money. Otherwise they can try and worm out of their way, charge you more, and I'm sure you don't want that. So the benefit of going this route is the speed. Traditional banks are slow, so this is why this sector has actually blossomed, because they can turn around deals a lot more quicker. They're geared up to that speed factor, and this is why a lot of business now is done on bridging and development. Bridging lenders obviously will lend on the value and not on the purchase price. So if you're lucky enough to buy something which is below market value, you could find that your deposit requirement isn't that great to actually buy it. So it's often a very good way to source and fund property. If you can get below market and you use a bridging loan, then it's better. If you use a traditional bank, they will only lend on the lower of the purchase price or the valuation. Therefore, you still have to come up with a 25 or 30% deposit. So bridging loans are very flexible from that point of view. The condition of the property is not really a major consideration, because given the fact you're going to be basically stripping it out or whatever, how it looks right now isn't the issue. It's how it will look after the work has been done. So you need to demonstrate that you will do enough to it to enhance the value within your timescales and costings, and that will give the lender confidence that you'll know what you're talking about. It is short term, so never ever take a long-term bridging loan or development finance. Try and manage it within the timescales, because time is money in these situations. The shorter your loan is outstanding, the less interest charges you will pay. You can refinance and repay the bridging loan whenever you want, or the development loan. There can be some exit charges, which we discussed earlier, so that will be according to your offer. They can't suddenly sneak them in afterwards. So if it's not there at the outset, don't let them charge you an exit fee at the end. And if you've done the development and it's not sold, then we do have developer exit products which take over finished developments and then allow you time, 18 months typically, again, to sell each item or each flat or whatever, and repay the loan back in stages. So, but the only sort of the good thing about these is you pay for what you use. You know exactly where you're going to be paying that money. So really, when to use these sort of loans is obviously in auctions where speed is essential. 28 days is normally what you get. I know some auctions do now give you 56 days because of COVID. That's better. But obviously with auctions, be careful of the fine print. Buyer's premium sometimes creeps in, and you must be wary that you don't take on any other liabilities. So your lawyer, again, can check the legal pack before you make any bid. When the condition of a property is pretty poor, that's often a good reason to use bridging or development finance, because standard banks don't like lending on that, particularly if it's not, for example, lettable on day one as a buy-to-let. People use these loans also for when they're flipping a deal. They can buy it, maybe they won't do anything to it. Maybe they bought significantly undervalued from a motivated seller, and they can just flip the deal. Use a bridging loan, job done. You haven't spent a penny, just your interest for that month or so until until the new buyer takes over your property. On residential to HMO conversions, very, very useful. You can use these products for that purpose. You can buy a house, get the planning for HMOs, and the development will be done for you pretty much with 100% funding. They will cover all the costs, providing you do all the work legitimately and within timescales. You can do it for that. Now, a lot of people are now buying commercial, ex-office blocks, converting them into residential flats. Again, a great way to fund it is through a development loan, if you can find the right deal, of course. And obviously for ground up developments, some bridging lenders and developers, some bridging lenders don't do ground up stuff, but there are many who do ground up developments because they're more riskier. A lot more can go wrong when you're building something from brand new than just knocking out a few walls in an existing development. So hence the choice is better. We have lenders that will help you fund the purchase of a failed development. So if somebody's started a project and something's gone horribly wrong, sometimes you can pick up these developments for a song, not very expensive. There might be some lending on it, so that can be cleared by your purchase. And you can often pick up these deals quickly and cheaply. And with the right funding in place, you can finish them to a good standard and sell them and make hopefully a tidy profit. PD rights are coming in, or have come in. So that's obviously very good news for you guys out there. Less red tape, and often with land, whether it's got planning or not, then these sort of loans are quite useful for that purpose. Our job is to match your particular needs to the lender. We have 200 lenders or so to choose from, and whether it's a buy-to-let that's clean, a light refurbishment, medium refurb, heavy, ground-up development, buying under value, commercial, we will pick the right lender based on the loan size, your profile, and everything else. So that's my job. And the good news is that the refurb to let product is back. It was out of action. Lenders were a bit nervous on lending on these sort of projects, but one lender's come back into the marketplace. And this is a product where you are buying a property to refurb and then let out. So it's one application, one valuation fee, 2 visits, only one lawyer, but you get 2 mortgage offers from the outset. So the benefit of this product is you don't have to be stuck on a 6-month bridge before you're allowed to refinance. This particular lender will refinance it to you, for you within that 6-month time frame, and the rates are pretty keen as well. The bridging rates start from sort of 0.54%, and the buy-to-let rates start from around 3.14, depending on the loan to value. So very quick, efficient way of actually funding buy-to-let refurbishment deals by using this particular product. There are obviously other criteria behind this, which we can discuss with you once we find your financial profile, but a fantastic product and very, very competitively priced. It's all good making the money, but don't forget about the tax, yeah? And part of the advice that we can arrange for you or give you is decisions around whether you buy this under your personal or company name, because if you buy in a company name, you don't get CGT relief. So, it's all corporation tax. So if you're not going to make too much a big profit, buying in your personal name might be just as good as buying in a company name. So lots of these little things. Section 24, loss of interest rate relief came in. For that reason, many people are buying in company names. And we don't know what's going to happen next year when we have to start paying back all these bounce back loans and things like that, and cease grants that the government's paid out to self-employed people. And then, but we can definitely see taxation increasing in 2021. So now we've got the vaccine. What happens next? Hopefully everybody will be vaccinated by the end of next year. Stamp duty is coming to an end, but I do feel the high street will be suffering still. I think that'll take some time to pick back up. But be ready for tougher lending, because we can all already see that some buy-to-let lenders are increasing their requirements for interest rate coverage, and that I think will come in next year as well. Short-term rates are going up. I know base rate is still at a historic low of 0.1, but do expect short-term rates to creep up also next year. So the key is work smarter, not harder. Knowledge is power, and as always, cash is king. So whatever you're doing, good luck to you. And any questions, please do let me know. Thank you.
Thanks for that, Bob. Do you know what? You said something there that was really key, which was about careful planning. And I think if you do any careful planning in finance, it's really achievable as well. So thank you so much for sharing that. We've got a lot of questions coming through. I hope you guys can hear me. But thank you very much for sharing that. I'm going to start off the questions. So if anybody has a question to ask, please feel free to use the Q&A tab at the bottom. If you have a question but you don't want to type it up, then you can just raise your hand and we'll be happy to put you in the panel. We've got a few more people on now, so I am going to request if everybody can keep their questions short and not too detailed, so we've got an opportunity for everyone to ask the questions. Just going to move on. We've got a lot of feedback saying thank you so much for the presentation. Really enjoyed it. So thanks for that, Bob. Bob is fantastic. He's got a lot of knowledge. So it's always awesome that you share it with us. Start with the first question, which is from Tom. Is it easier or harder for a full-time property investor to get refinancing on properties? My wife and I earn £80,000 collectively through 3 properties, but will a high street lender lend to me? Many thanks.
Good morning, Tom. Yes. Now that's a good level of earnings. So I think you're going to be pretty much considered by all the banks. Now, high street lenders do lend. It's not that they don't lend. It's just that their criteria can be a little bit steep and to qualify. But if you're looking to refinance, if they're particularly buy-to-let properties, that should not be too difficult for the high street banks to deal with. They don't always offer the best rates, but we can always beat their rates hand down. So I don't think you'll have many problems unless there's something untoward about your history or job style or whether you're currently furloughed or anything like that. Getting funding should not be difficult for somebody in your position. You can get refinancing right up to 75% for buy-to-let and 60-65% for commercial. So if you don't get any luck, then give Sam or Artie a call with your details, and then we'll certainly try and help you.
Brilliant. Thank you very much for that. I hope that answered your question, Tom. Right, okay. I've got one from Anonymous, which is, can you please advise why second charge mortgages cost higher? I think you may have covered that.
Yeah, I think basically because you're second in line for the cherry, if you like, it's a slightly higher risk, because if the existing lender is already lending 75% and you're borrowing and you're lending a little bit more above that 75%, then obviously, unless that bank in a repossession scenario gets their money back, you stand to risk losing your lending. So that's why second charge lending is priced a little bit higher. It's because it's higher risk. That's all.
Brilliant. Thank you for that. Yes, you can get a recording of today's session. It's going to be uploaded on our YouTube channel, possibly by the weekend. So we will send everybody a link of that. Right, moving on. Just checking to see if there's anyone who wants to come to the panel. In the meantime, I've got one raised hand. Ashu, that's you. I'm just going to invite you onto the panel if I can. Mine's frozen actually at the moment. I am unable to invite anyone to the panel at the moment. Bob, I'm not sure if you can do it or not, but we've got a couple of raised hands. For some reason, mine is stuck.
I've got some questions here.
Yeah, let's go through that.
It says, how do you go about some properties below mortgage lending? Say it's like 39,000. Yeah, lenders do like to lend, but they don't want to lend on the very, very small stuff. That's the sort of financing that's generally done with cash. But most lending starts off at 30,000 or 25,000 in some cases, because any lending above that is not Consumer Credit Act related. So there are lenders that will lend to you. So if you've got a particularly small project, it could be something that your own bank helps you with. If not, then give Arthi or Sam a call, and we'll try and find you a lender for that purpose.
I am struggling to invite anyone on the panel today. I think I've got just a bit of technical issue there. I'm going to keep on trying though. But in the meantime, I don't know if you can try or not, Bob, but we've got a couple of raised hands.
Yeah, I'll try and answer the questions as well as I'm talking.
Awesome, thank you.
Great presentation. Which lender is the bridge to let offer with? Now, that's my secret. So if you give me a call, I'll let you know who the lender is. It is a lender that's already in the marketplace, but they did used to do the product before they came out of it at the start of COVID. They now feel a bit more confident. They're back in with it. So it's a great product. It's fantastic. And most banks, yes, they do like to keep you on the bridge for 6 months, but this one doesn't. And there are other lenders that will let you remortgage to them if you're still in a bridge and within the 6 month time frame. But the issue there is on what basis does the bank value that property? Most will use the purchase price, but again, there are the odd two that do understand this sort of lending a bit better, and they will lend on the enhanced price. So both ways we can help. Independent lending between the bridging lender and the ultimate lender, or we can do it all in one, which is very convenient because it gives you that surety you'll get a buy-to-let mortgage, because the offers come out for the bridge and the offer at the same time, for the buy-to-let at the same time.
Brilliant. Do you want to go to the next question? I am actually struggling, guys. My apologies. I cannot invite anyone to the panel. I'm not sure what's happened with Zoom. So I know Tom and Ashu, you've got you've got your hands raised, but if you want to type them in the meantime, I'm struggling a little bit. I think so is Bob. There's a technical issue, isn't it?
Okay. I'll try my best to carry on here.
No worries. That's fine. Do you want to go on to the next question?
Yeah, it says you mentioned rates as low as 0.5% a month. Typically, at what sort of LTV would that be at? That would be at obviously the lower end. So we're looking at sort of the 50% level to 60, possibly. Anything above 60 is standard rates, and you will pay a little bit more. But even at that sort of level, it's not drastic. It's a price worth paying for the achieving the ultimate end result. Right.
All right, we managed to get a couple of attendees on. So we've got Ashu, you've unmuted yourself. Go for it. Sorry about that.
No problems, Aarti. Thanks for organizing this. And thank you, Bob, for a great presentation. My question really is, I'm building up my portfolio. I have 3 HMOs. I'm going for my 4th one, which is 8 bedroom. And the banks keep asking, what is my salary? Okay, my salary is maybe £100,000, but I'm building up a £1 million or £2 million portfolio. And for me, it is the project. It's actually the project that is generating the cash flow that will pay the bank. And why do they keep asking for the salary?
Yeah. They ask for it because certain banks like you to have a bit of income outside the HMOs. Excuse me. But most banks don't actually ask that question. We have banks that allow 0 income and still let you have money on a HMO. Typically, in buy-to-let circles and HMO circles, most lenders prefer a 25,000 income.
How much?
25.
Oh, I've got 100,000. So
yeah, so they should not be really too fussed about your income. So I'd like to know which lender that is. But if you're earning 6 figures, that should be the last of their worries. They should be more focused on your ability.
It's a Hampshire Trust Bank.
Yeah, Hampshire are very, very thorough lender. Yeah, they do have minimum earnings requirements. With some cases, but we have done some funding with them. They're very, very thorough. But given that you've already got 3 HMOs, you should not be having any issues in getting a 4th one.
Okay, so that's my first question. The second question is, I'm based abroad. I'm actually I live in Geneva, Switzerland, and for some reason the lending rates are higher for. Although I'm a British citizen, the lending rates are higher, and I can't understand why that is.
Yeah, they perceive you as a slightly higher risk because you're not here on the ground looking after your portfolio. Yes, you might have managing agents, but even with standard expat mortgages, they perceive the risk to be slightly higher. And obviously lenders now price for risk because you can't come overnight on a plane and sort your mess out if something happens on your HMO. So just for that reason, and it's possibly another excuse to get 0.5% more out of your pocket. It doesn't make logical sense, but this is how they work.
Okay, so my final question is about development finance. For example, if I'm doing a refurb, I buy a property for 300 grand and I'm doing 100 grand of refurb, is that considered as development finance?
It is, because you're developing the property further.
Okay.
You're going to be knocking out kitchens, bathrooms, walls, replastering, rewiring. The property halfway isn't going to be in any position to sell easily.
Okay, great, great. I'll reach out to you privately, Bob,
Yeah,
if that's okay.
it is. Thank you.
Cheers.
Thank you. Right, we've got a couple more people that want to be on the panel, so I'm going to unmute them. I've got Adam. If you can please unmute yourself, or if Tom's ready to go. Tom, I think you're unmuted. Go for it.
Hi guys, thanks so much for the presentation, Bob. You touched upon my question earlier. It was just basically, so my wife and I, we are full-time property investors, and so we earn sort of £80,000 between us through rental income, and we haven't had a single missed payment over the sort of COVID period, thankfully. So all's well on that end. But I've heard that if you don't have income from, like a standard job, for example, if all your income comes from property, that it's more difficult to get lending. Is that true in your experience, or is it just a case of maybe the high street banks won't lend to you, but you'll have plenty of other sort of more specialist banks that are willing to lend to people who only have income through property?
Yeah, spot on. High street banks don't really like full-time property investors, but there are, again, lenders that do understand your particular breed, who make their money from property, whether that's developing or rental or whatever, and they don't mind you having all your income from a rental stream.
Okay.
So high street banks generally prefer a job, and that's why, as Ashu mentioned, they were asking about his earnings. 25,000 is typically the minimum by most lenders. Some even go as high as 50. They won't talk to you unless you're earning 50k. But in the broker space, we have lenders that don't want any income whatsoever, as long as you've got some income. Even a housewife could buy a buy-to-let who doesn't who owns their own house, for example, is a party to the joint mortgage, doesn't have any income outside that. We have a lender that will lend to the housewife. So this is where obviously we need to understand you as a person, your profile, what you're trying to achieve, and then go out into the marketplace, find the right bank or lender, and try and get the best terms for you for your need.
Okay, great. I just have one final question, Bob, and you touched upon it already, answering, I think, someone else's question, and that was with the 6-month rule. If we were to buy a property that needed sort of complete refurbishment, as in it's not even in a livable state at the moment, we were able to buy in cash, for example, develop the property and make it sort of lettable again, but we wanted to then refinance to 75%, say, within the 6 months. Other than the sort of a bridge to let product that you mentioned, are there any lenders that will consider lending before the 6 month? Again, I assume it's specialist lenders, and high street banks won't touch it.
It's specialist lenders only, as long as you can show a timeline of photographs, a timeline of your costings, how you've actually improved that property. If you can demonstrate that, then they'll lend you on the end value or the current value post completion. So you don't always have to wait 6 months. They're not the best rates, if I'm honest with you.
Yeah.
So for that reason alone, I say if you've spent 3 or 4 months doing the project, just wait 2 months and get 75% of your interest rate, because these specialist lenders love charging you 3.5% to 4%, whereas a standard buy-to-let is going to cost you 2.1%. So
absolutely.
So you end up paying a lot more interest by going to a specialist lender, just because you want to refinance within the 6 months. If you can wait 6 months and do it afterwards, then you have the whole market to choose from, and you'll save a lot of money in the long term. Because obviously, if you're in the investment game, you're not buying for the short term anyway. You're buying for the long term, and the specialist banks do not like giving you follow-on products.
Okay.
Their SVRs are pretty high. If you look at the KFI illustrations, their SVRs are 4.5% to 5%. So what you don't want to be doing is going with a specialist, then ending up being stuck on an SVR and then having to come back to a retail bank later. So we always try and go high street first, get the best rates, and that will hold you in better stead, because these banks will give you follow-on products, and they're easy to do.
Okay. I appreciate that, Bob. These presentations have been fantastic, by the way. So yeah, I look forward to sort of as many as you can do or fit in your schedule. Thanks so much.
That
Thank
depends on how if Aarti lets me back on.
I've actually got you on for another one, which I haven't told you about. So you're going to be on another one next week, just for a couple of minutes. So not too much of your time.
Yep.
We've got Adam, who's been waiting quite patiently as well. A couple more questions. I will have to leave very shortly, but Sam's going to be taking over. Adam, if you can unmute yourself, please. In the meantime, I think we are all right to go for a question. There's one here. It's quite an interesting one, actually. For those asking about the discussion, we will be sending them out on our YouTube, so you will be actually getting a copy of that as well. Right, there was one here. Anonymous, I'm 63. Is there a way to boost chances using the lenders?
Age is just a number in lending. Bridging, development, buy-to-let is under the non-regulated category, so age is immaterial. Age only comes into play when you're buying to live in, because most lenders will not lend to you unless you've got a hefty pension. So you can't really go beyond the age of 70, 75 at a push. But if you want to go beyond that, they rely on your pension income for the onward lending. If that's not enough, and if you're a couple, and if the single pension isn't enough, you won't get any lending into retirement. It's very hard to get. So that's on the regulated side, where you're living in the property that you're wanting to fund. If you're buying to rent out, buy to let, development, bridging, commercial finance, all that stuff is non-FCA regulated, so age is not a factor. So we have buy to let lenders that will lend to you all the way up to 100. So do not let that put you off.
Brilliant. Thank you for that. One more question from me, and then I'm going to hand it over to Sam. Is anything particular that you want to answer, Bob, that hasn't been addressed in your presentation?
Lots of interesting questions coming up. Obi is asking.
I was going to go to that one as well, yeah.
He's got a 75k in the bank. Lucky you. But yeah, auction properties, you never can know. You never know what price they're going to end up at. So what I would start off really on the private treaty market. Look in an area where 75 would buy you your property outright, and then we can come in with the development funding after that to help you finish it all off, and ultimately refinancing that on a buy-to-let product, or selling it and making a tiny profit. So I think just look for in an area that is priced accordingly. I don't think you need to buy at auction unless that property is obviously well below 75k in the first place. But don't forget the hidden costs of buying at auction. Be careful.
All right. Okay. I hope that's answered Obi's question. Right. Okay. Let me just ask Sam if he's got any questions on Facebook as well. Like I mentioned, I'm just going to talk to him really quick.
Okay. Yes. Hello. Good morning again, Bob.
Morning.
Sorry, Sam. Before you carry on, is it all right if I excuse myself?
Yes, please.
Yes, please. Thank you. Done a brilliant job. Ati and Bob, you guys have been fantastic. Yeah. Bob, we seem to have quite a lot of questions coming on from the Facebook feeds.
Okay.
I know you got a limited time, so we'll probably leave those ones for our session next week. But just before we actually go on, when Boris Johnson stood and said bill, and with the change of commercial use class for planning, they've opened up a wonderful and a great opportunity to add value on the high street. One of the questions, and quite a few of the questions I've seen online, they're actually alluding to that ability or possibility now to add so much value to property on the high street, converting it from commercial to residential. Are there lenders that would work with you, bearing in mind the possibility that you're going to be adding a lot of value? So if you're buying something that is not so much value right now, would they lend based on the future hope as well, or hope value?
Yeah, the whole ethos of development funding is lending enough so their position is secure at the outset, but also then lending enough to finish the project and leave a fairly big margin based on the end value.
Okay.
That's called GDV, gross development value.
Okay.
As long as your total lending doesn't exceed sort of 70-75%, that's within sort of guidelines. Not that you actually take it all that level, because if you're doing a major development, there should be a lot more fat in it than just 25%. So lenders will look at the end value, of course they will, yes.
Okay. Yeah, because I think one of the forum that I belong to that's getting so many technical questions, there are people that are actually looking a lot at what's happening on the high street. I think the ethos here is a consultation. Is it possible maybe to arrange, I don't know if it's Zoom or in person, maybe a day next week or week after, to actually have a mortgage or project consultation with you? Is what they're asking, where we can have instead of a presentation led like today, maybe arrange either in person where people can come to with projects to consult, or on Zoom. Is that something that we can get set up?
Yeah, I'm around for one more week. I'm taking a short break, but I'll be on Zoom wherever you want me. Okay. I'm happy to meet anyone. Yeah, we're the sort of we are meeting people in the office as well with face masks. And but if you want to do a Zoom type meeting where people can come on and ask their questions, I'm happy to do that wherever I might be in the world.
Okay, so because quite a few of the questions from that group are very specific, where people have real life projects to actually inquire about. So that we definitely have a chat and come up with a day that can be a consultation day, either in person or, like I said, on Zoom. So talking about taking a break, so you're going somewhere nice? Just distracting.
It's personal family business. It's a bit of a sad occasion. We're taking my grandmother's ashes to India, so.
Okay, so you're traveling to India then. Okay. That's good. I just thought I pick up on the fact that you're going away, because you tend to work around the clock. So I'm not sure when you say you're going away. I thought
I'm not a property developer, so I can't really afford much.
Yeah. So wow. Okay. Gonna go there. Okay, that's good. I know we just topped the hour. I know you've got somewhere else to go for 1 o'clock, as usual. Thanks, Bob, for the great presentation. We've got lots of questions coming in, especially on the social media feed, but we will collect those for you to then deal with, and then we can talk offline and arrange a day for that consultation and what format it will take. Let me just see if, or do you still have time to take any of the questions that are coming in, or we'll just leave it as that?
No. I'm here for you guys, so please.
Okay, so since we probably just leave the questions that are coming in, and then we can deal with it and arrange the consultation day. You got anything to just sum up?
No, it's a very exciting time for developers. I mean, there's lots of opportunity. The auction houses are doing record business again. People are waking up to the fact that auction buying is a great entry point into the market, particularly if you can buy well. Now, it's quite often harder for the first-time developer to buy below market value in a private treaty scenario. And this is where people like Midas and you guys come in, who can help source property possibly at a good price from outset. So you're buying at a discount, so that gives you a bit of a leg up on your profits. But my advice always is don't overstep the mark. Don't take on more than you can chew financially or experience-wise, because bridging loans, development loans are a ticking time bomb. Every day is costly, and unless you do know what you're doing, don't leave your problems to come up halfway in the project. Make sure they're ironed out before. Do not take that risk.
And I think that there's one here, someone is actually repeatedly asking that it's quite important because they need to use that information. JV, if you have a joint venture partner that is putting money into the project, and you're going for funding, how do you deal with that? Do you declare that joint venture money as your down payment, or how do you do it?
Yeah, typically what would happen is you would set up a JV agreement, and for that you'd need a lawyer to maybe draft up something. You would invariably buy using a limited company, and your shareholdings would be reflective of your stakes or your end result wishes. So you have the JV agreement, depending, deciding on whose responsibilities are for what, and then the shareholding in the company would decide what dividends or profits you take once the project is over. The banks will want to know who your JV partner is. They will do their money laundering checks on the cash, and again, after that point, the project will be assessed as any other. The JV partner's experience, your experience, the builder that you're going to use, their expertise and their excellence, all will play a part in that decision-making process for the bank to lend or not lend. But it's one way to get on the ladder, get somebody who knows what they're doing, you might not have the time or the experience, and the JV partner might be already doing this with many other people. So therefore, is happy to take you on board, take you under their wing, help you along the line, with the first one. And then as your cash balloons in value, you can take bigger stakes in the subsequent projects. And that's how it starts off. Many developers start off small, and within a period of 3-5 years, start to have some pretty hefty profits coming through.
I think there's a follow-up question. You actually answered it, because they asked, do you have to declare to the bank the full names of your JV partner? I think you answered that question actually for them, which again, okay, I guess the banks will have to do their due diligence as well on the JV partner, because it's a joint risk. Okay, so I think I say, well, we've got lots of questions coming through from social media, people who couldn't come on Zoom, that are just following from LinkedIn and from other places. So we'll actually get them on, probably send all the questions for you to then answer directly to them. And once more, thank you, Bob, for taking the time. So, and thanks to everyone that's taken time off to attend this today. While Bob is going off, I'll just say a bit about Midas here. Again, thanks to Ati. Ati's had to pop out. She had a meeting for just after 1 o'clock, so she's walked away. So I'll just end this on her behalf. Thanks again for coming in. Just in case it's your first time here, Midas, we would organize events. We share lots of knowledge, like we just done this morning. As a business, what we do, we help with acquisitions for our clients. We help with disposals. So if you do have any properties that you need to actually sell, we would actually help you. We've got quite a few ready buyers. Just by show of hands, how many of you here are actually selling a property right now? If you can just click on, just put your hands up if you are in the process of selling a property. If you are, please get in touch with Midas after this event. We can actually help you sell quite quickly. Okay, I think we've got a few hands that have come up. Okay, so what we'll do, we'll call you to actually see if we can help you, which we should be able to help you sell for yourself quite quickly. Is there anyone that's buying right now? Anyone in the market buying? How are you finding the market? Okay, so I'm just trying to look at, so we've got quite a few people that are on the market. So I think if we take this as a poll to reflect, so we've got maybe one or about 2% that are selling, but quite a few more that are buying. So could this be a reflection of the market, that almost everyone is buying, but very few people are selling? Okay. Just before we actually go off, I would kind of like to get someone's opinion of the market, how they're finding the market. Is there anyone that wants to have a quick, let me just get the names down. Is there anyone that wants to have a quick shout out of how they're finding the market? If you want to do that, please, if you can just put your hands, let me just put everyone's hand down so that we can see who wants to have a quick, I'll just put, okay, let me put all the hands down. Now, does anyone wants to tell us their view of the market? What's happening to the market right now? Their experience. Okay, I'll get Keith. I'll get you on to panel to just quickly, 2 minutes, share your view of the market right now. Okay, you can just unmute yourself and just tell us what what your sentiments are of the market.
Can you hear me?
Yes, we can hear you clearly. Yes. Okay.
Hello, Sam. With properties at the moment, it does seem to be a bit of a buyer's market. Properties do seem to be getting snapped up pretty quickly. Commercials, not so much. There are some deals out there, and the prices seem to be quite good at the moment, but it's just knowing what to do with those commercial properties when they become available.
Did you say it's a buyer's market or a seller's market?
I'd say it's a buyer's market at the moment.
It's a buyer's market. Well, from our little question, I think we had 1 or 2% that are selling, but quite a lot more people that were buying. So isn't it, if we have more people buying than people that are selling, shouldn't that be almost a seller's market, as it were?
Well, yeah, I suppose it is a seller's market. The fact that everything is going quickly, but whether they're getting the right prices for them, I don't know. So it's whether or not it's a buyer's market because the prices are low, even though they are selling quickly, if that makes sense.
Absolutely. And then one of the comments that I got from one of the estate agents earlier is that they're having to sell most stock on the third attempt. That most of the time the first or second offers are accepted don't seem to go through, and I think that's something that we're actually experiencing. The estate agent said on the market, where the first one or two attempts do not actually seem to go through that much. Okay. Yeah. So, and then Keith, I think you mentioned something about the commercial market.
Yeah.
For those of you that do residential and commercial, the commercial market is very different from residential in terms of the way properties get valued. The challenges that we're having with COVID are they're really not affecting the residential market as much as the commercial, because with a residential market, you can actually ascribe a brick and mortar value to a property, which almost is fixed to it. But on the commercial side of the business of property, it's all about what is being done in that building that actually gives it most of the value. But right now, with lockdown, lockup, stop start, no one knows what's happening in any commercial building, especially on the high street. So, which is why Keith is saying the commercial sector seem to be struggling right now a lot more.
Can I just add to that as well? Because it's true when you said that residential properties, whether they're empty or somebody's in them, they still have the same value thereabouts. But with a commercial property, that affects the value, because if you've not got anybody in renting it, it's quite difficult to value the actual property.
Absolutely.
And base it on what the rental income is, don't they, as well, you know?
And that's why it's so easy to blind buy a residential property at auction, but not commercial, because with a commercial property, you just cannot blind buy. You're meant to actually know what a lot more, whereas with residential, you can stick a finger in your mouth and say, well, this is it. If a property on that street sells for this number, I can bet that this property cannot be that different from the one next door. But that's not the case with commercial. You need a bit more skin in the game. You need more boots on the ground to actually be able to make a decision of that. Okay, so Keith, thank you for the contribution, and I think your contribution has been very valuable on your sentiments about the market. Is there anyone else that wants to share their current view of the market at all? Okay, if we haven't got anyone else that wants to share their view of the current view of the market, at Midas, we actually help our clients, hopefully all potential clients or existing clients of ours. We can actually help yourself acquire properties. There are quite a few people, about 6 or 7 people, that put up their hands that they're buying right now. So what we could do, we will actually get in touch with yourselves. If you're quite happy, we'll actually help you acquire the required properties. We deal a lot with auction properties. Auctions are usually our preferred transaction method. We prefer to have committed buyers and committed sellers, as opposed to high street or private treaty, where you just don't know what you don't know until probably 3-4 months down the line. People are not committed. So please, we would have a chat with yourself and then see if we can actually help you acquire this property. And once more, thank you. Not sure if IT shared our contact details at the start of the event. If not, I would follow this with an email and send you contact details. You can call me if you want to have a quick chat about your situation. Okay, thank you and goodbye. Okay, thanks for making the time to be on this event today. Bye. Okay.